Hey everybody, I'm Joe Killinger. I'm a real estate investor and entrepreneur, and we put these videos together every week to give you all the tips and insights from my experience over the last several years. So make sure you tune in and subscribe, and thank you. Everybody, thank you for tuning in. I was talking to somebody the other day. They started asking about zero cash flow investments. So I decided I need to get educated on this because I knew very little about it. So for that, I asked George Pino. George, thank you for coming in today.
Thanks for having me.
George is CEO of Commercial Brokers International in Los Angeles, and he's my go-to for all these type of questions. So zero cash flow investments. What exactly is it, and why would I want to invest in it?
Okay. Well, I think what it is, it's really simple and straightforward. The why, though, is a little bit more difficult. And
the sticky part.
But, you know, the zero cash flow investments, they've been around for many, many years. And typically they are a subcategory of a lot of STNLs or single tenant net lease deals. And it's exactly the way it sounds. It's that it is a property that has been highly leveraged, so that 100% of the net operating income goes to pay off the loan. So all of the net operating
sounds like
income,
a bad investment.
all of the rent goes in. It kind of sounds like that, doesn't it? But
it
not
does.
necessarily, because there's a lot of benefit to it.
Okay.
Even taking out the fact that let's just take out the depreciation benefits. Let's talk about long-term hold. You know, so when we talk about long-term holds, a lot of things, you know, a lot of people just focus on current rental income.
Yep.
And that's good, but at the same time, if you're using the power of leverage and you're able to go in for much lower value and hold on to that property for a long term, your yields can actually be better than if you did typical regular financing, because when you are buying a property, your payment that the rent is going to is not just paying interest, it's also paying off the loan.
Yeah, you're buying down the loan.
So you're buying down the loan. Another great aspect.
And appreciation.
And you have potential appreciation. Even without appreciation, though. You know, I just did a modeling on a CVS, and typically speaking, the tenants are, one, you have to have a lease that is 20 years or longer to be able to set something like this up. Or you have to have a tenant that is a credit rated tenant, so to speak, BBB or better. And then you have companies or lenders that will give you long-term financing, that non-recourse, so that matches along the lines. Now, there's a couple benefits to this, in that I did a modeling with a property that was a CVS. They're selling it for $7.5 million. You could actually acquire this property for less than $1.8 million in equity. So very high leverage. And the nice part about this is, just looking at the yields, if you did a zero cash flow stream for the next 20 years, and then on top of that added in the gain on equity by paying off the loan over that, the yields are still in the low teens.
Right.
So it's actually better than potentially going in and getting a regular property. And that's not even taking into account the fact that you actually have benefits for the tax benefits, as well as benefits potentially for appreciation. And more than likely, the property is going to appreciate in 20 years. But doing a very conservative modeling, we did it so that it was sold at the same price in 20 years that they purchased today. So there's definitely something to take a look at, and realistically, it should be part of a portfolio for someone that is a little bit more perhaps advanced.
Yeah, it sounds like a sophisticated investor would be.
Absolutely, and also what the beautiful part about this, there's two things. On a 1031 exchange, you know, they have what they call a, this is perfect for somebody who is selling a down leg and has a lot of equity in a property, because what they do is they structure the loans to be a cash readvance. So what that means is, let's say it was exchanging a property for $7.5 million. I sold it. And I see this CVS now that we were just talking about. I can actually go in, put all $7.5 million into it, and then I get a cash re-advance at the closing equivalent to the difference of that down payment. So the down payment was $1.8 million. So I'm, in turn, will get roughly $5.7 million cash back.
Okay.
Actually, less than what, and this is tax-free with no capital gains. And I can now reinvest that into more cash flow properties that actually cash flow, but at the same time, I increase the basis because of that, so I have more tax depreciation and benefits by acquiring additional properties, new, because my basis transferred to the one that I just bought. And then what end up having as well is I now have a property that I own that in 20 years will be free and clear, and I paid less than what I would have paid in capital gains to acquire it.
Okay.
So that's one of the beautiful parts about the cash readvance program, where, if I'm looking at paying capital gains, I might as well own a property that's going to be a trophy property in 20 years from now. On top of that, I have potential for depreciation that's going to offset my income as well. So I have the potential for depreciation, or more importantly, with these properties with zero cash flow, as long as the interest remains more than what the payoff is on the note, the gain on equity, then there's really no taxable event at that point. Now, you do have to worry about phantom income down the line.
Phantom income.
Phantom income.
I wished I had more of that.
Yep. Well, no. I just wish more income. Phantom income is nice, but that's when you're paying more on the gain on equity than you are in interest.
Yeah.
So because of that, you actually have, even though you're not seeing it, phantom income on papers that you may have to pay taxes on. That doesn't happen until later on, but there are definitely ways to get around that. You can do different cash advances. You can also even sell the property. And even if it's at a little bit of a lower price because you're going into it for such a high or low down payment, you're still getting really good returns on this. So, and you start looking at it maybe 10 years down the road on a 20-year type lease, this is what I'm looking to do. So it should be part of your actual plan and forecasting, working with your CPA, your financial advisor, whomever it is. Because, and also the nice part is that if you do it right, let's say that this isn't part of a 1031 exchange and you're just acquiring one of these properties, with the added depreciation benefits that you have, it can really offset your other income as well, so that it lowers your tax brackets. A lot of people are concerned right now with elections coming up that their taxes may go up. This may be a good way for them to utilize sound real estate investment strategies to offset their income on paper and lower their tax basis.
Sure. Yeah, be a great way.
Yeah.
All right. Well, that was, I guess now we know, right?
Yeah.
Well, thank you very much, George. That was very informational. I've never gotten that deep into it. So I will put George's contact information down below. And I bet you guys might have some questions on that. So don't hesitate to reach out to him. Or you can reach out to me and I will reach out to him. George, thank you for coming in.
Thanks for having me.
That was a good one. I really appreciate the information. So, and we do these every week. So if you haven't done so yet, please do subscribe.